Welcome to another edition of the Business Brains and the Bottom Line podcast. My name's Paul D'Allegro, and my guest today is the author of Retirement Money Secrets, Steve Selengut. Steve, welcome to the show.
Thank you. Thank you. Good to be here.
Okay. So, Steve, I'm going to show the book. I did read your book, and I have to admit, you really opened my eyes to a lot of things. So I would fall into the categories we'll get into later, the buy and hold, right? So, and I'm like, I know I'm not alone when I say that. So, but we'll get into that a little bit. The first question I always ask an author is, why'd you write the book?
Oh, I guess the main reason was that I wanted to get it all down in writing on paper, in a good format, and all collected my thoughts while I was still managing other people's money, but also while I was in the process of selling my business, because I didn't know what was going to come next. You know, I knew I wasn't going to really retire. I knew I was going to start something. The idea of coaching had come up. I was thinking about it. And as I got into writing the book, with the help of the ghostwriter I was using, it became a real deal. You know, it made sense. It was something, and the book could make it happen. And that's how the book was designed. As you saw, it leads people. It creates an awful lot of questions in people's mind, and they need to talk to somebody about.
Yeah.
And talking to their current financial advisor wasn't going to help. So that's why I wanted to get it all out there so I could help people with it. And then I decided I'd actually physically help people with it by coaching.
Yeah. So you're retired from the actual managing people's money business. Now you're just a coach. You try to help people, right?
I only manage my own portfolios. I don't even manage my children's and grandchildren's portfolios anymore, just mine.
Really? Yeah. Well, you reach a point in your life where, not that you're too old, but you reach a point where you just say, hey, it's time to pass it on to someone else, right?
Right. And you hope they take over, and you hope they've read the book and that they can take care of their own things in the right manner as well. Yeah.
So, and again, we'll get into your philosophy, which I found interesting in a little bit, but do they actually follow your advice?
Not really.
That's funny.
They're pretty well. Actually, one of them, the main one, the one who has the most money, the one who's got the really big job and does have a lot of money. She's following my advice by using a financial advisor that I have coached and I have vetted and trained so that he is kind of a clone of me. Yeah. In the way he runs people's money. So.
Well, you had said that in your book, once you decide you want to use kind of your system here, you kind of fall into three categories, right? You got, the guy who's the do-it-yourself and wants to do everything. Mm-hmm. Then there's the do-it-yourself by using a coach like you. And then there's the guy that wants just a financial planner to do it for him. Do I give that right?
That's right. But you know what I found out since I started coaching? And I've already coached over 100 people, which is kind of nice.
Yeah.
But I found that most people after 2 or 3 sessions are really, really become do-it-yourselfers really quickly.
Yeah, I can see that happening, because I was thinking the same thing. I was thinking if I ever went to my financial planner, he'd probably, okay, yeah, well, we can try some of that. And he probably wouldn't do it the way I wanted him to do it, right?
Not likely that he would. Not at this stage. He wouldn't. He wouldn't be willing, I think, to leave the fold of what they have a menu of products to deal with you, a model. Typically these days, it's a type of a model portfolio of some kind.
Yeah, no doubt. And I think that he would even admit that. I've talked to guys. They say, I've never had an original idea in my life. I follow the, and I've heard financial planners say this. They go, look, I just follow the plan, right? X years old, you have this much money, you want to retire in this many years. This is the plan we're going to put you on.
Isn't that scary?
Yeah, it really is. It's, but I'm ashamed to admit, Steve, I'm one of those buy and hold guys that you made fun of in your book. I wouldn't say you make fun of them, but they were
I
kind
don't
of,
make fun of them.
but
It's what they've been led into.
Yes.
What they've been taught. And people they certainly don't get the education they need in high school or college unless they go into the field of what it's all about, of what's a stock and what's a bond. What's the difference? Which one's safer, a stock or a bond? A lot of people will tell, well, the stock because it goes up more. So it's really the information's out there, but it's not provided in part of the educational system. That's for sure.
Yeah, I would completely agree. So, well, let's get into it a little bit here, Steve. I mean, your system, you talk a lot about closed-end funds. I got to admit, I knew a little bit about them, but I didn't know enough. And your whole philosophy, just correct me if I'm wrong, and I'll let you elaborate on this, is you want to generate income while you're retired. That's the focus here, correct?
Yes, the overall objective is to be income independent. You want to have enough income coming in to take care of everything.
Yep.
If you're a wealthy person, you want it also to take care of your adventures overseas and your travels around the world, like I have been able to. And you don't want to have to worry in the face of market corrections and interest rate hikes that it will somehow impact your income. And that's where we're leading them. And we do it, and as you've learned from the book, we do it by developing 2 streams of income.
Right.
2 streams. So,
yeah, and what are those 2 streams, Steve?
Oh, okay. That was a test, by the way. You failed miserably.
Yeah, I may have missed that one, but if you tell me, I'll probably remember.
I was told to do that to you. Remember, your
producer
that's true.
That's true.
I was told.
Yeah. Well, I got to
don't
admit,
take it personally.
I read this in one day, so I may have glossed over a few things to get to what I consider the meat of the book. I did read the whole book, but you know the drill. Well,
I'm with
to
you.
that point.
But the two streams are the distribution income that the closed-end funds provide, and the other stream is the one you create yourself with your disciplined profit taking.
Got it.
So it's 2 separate streams. Okay.
Well, let's get some definitions out there. What is a closed-end fund? Like I said, I've heard the term. I've heard it, mentioned before. What is it, and what are the benefits of owning them?
Okay. The closed-end fund itself is a pass-through trust vehicle. Like one would have in an estate plan, they'd create a trust for their for grandchildren and so forth. That's what these are. They're pass-through trusts. It's a form of investment fund. It's actually the oldest one that I know of. It was developed about 30 years before mutual funds were, and possibly 130 before ETFs or anything like that.
Right.
So, what's a pass-through trust? It's a vehicle where the net income produced within the trust, net after expenses, 95% of it has to be distributed to the share owners. Okay? Now you can imagine how that would be if Amazon had to give us 95% of its income. So it wouldn't have grown like it did. It wouldn't be Amazon. It would only be Amaz,
Yep.
And so you can't. These vehicles are not expected to grow in market value. They're expected to produce income, and they do it at a rate. Right now, the equity, the ones that contain mostly stocks, are paying around 9% in distribution income. The ones that are in mostly bonds and preferred stocks and things like that are paying just over 10% in income at current rates. And so their structure is different. They're not just like a stock on the New York Stock Exchange. The price is in pretty much no way at all related to the core value of the enterprise, to the book value. It's either at a premium to it or it's a discount, but they're not tied together in any way. Mutual funds and ETFs are tied to the net asset value of the fund. Closed-end funds are not. Their price depends on supply and demand, just like stocks. So that's two of their basic differences. The third one is that their focus is income generation and not growth in market value.
Right.
So that's the difference between a closed-end fund and a mutual fund and an ETF.
Yeah, that makes sense. Now, and I think from the book, I mean, you wouldn't put all your investments in CEFs, right?
I do. And
You
I
do?
have
Okay.
Well, actually, that's not true. I have 20 ETFs that yield about an average of about 10% that I also invest in, and I trade them the same way. I consider them more risky, and I don't even provide them. I sell my selection universes, and I won't even give them to anyone that I haven't seen for facts that they have a certain amount of assets before I'll even give it to somebody.
Yeah.
Because I don't, they're not as safe as closed-end funds.
Yeah, those closed-end funds, I know you have a lot of guidelines. Like you're not gonna buy one unless it's been around for X amount of years. So you want some stable stuff. But it makes sense, right? Like, I'm not retired yet, but I'm thinking, let's put it this way, I'm closer to retirement than I am the beginning of my career. So I've got a few years left. And you got me thinking about, I've got a nice nest egg, but man, how do I generate revenue from that? And that's what really intrigued me about your book is, wait a sec, my portfolio's growing, but unless I trade in some stock or mutual funds, I don't get at it. I don't have any access to it. Well, I take that back. I have access to it, but I'm not. It's not generating revenue for me.
It's not generating any spending money.
Right.
Right. And that's the thing. The way the investment industry, the advisory business in the investment industry is designed, it's not designed as an income producer. It's designed as a way to establish a wealth that we're going to chip away at when you retire. We're going to take 4% of it away and give it to you every year.
Right.
And hopefully you'll live long enough that there'll be still something to give you that 4%. It doesn't account for that trip you want to take around the world with National Geographic at $200,000 a head. It doesn't take your grandkids' education expenses that you might want to have to or might have to pay. It doesn't take care of the hip replacement if you're pre-Medicare. You know what I mean? It doesn't take care of everything. It doesn't think ahead. What if they need more than 4%? You know, depending on your spouse. 4% may not be enough in your household, right?
Yeah,
so it doesn't.
It's funny.
I
had a sales manager once that said I always wanted to hire guys with wives that have expensive taste.
Right? Because
that means they got to make more. That's right. They got to work hard and make more money to supply the wife with all her needs.
Right.
But
so that's the community. The community out there is designed to grow market value, and maybe I'm a little bit cynical, but I used to be an investment advisor, so I knew how I got paid.
Yep.
And I got paid based on the market value I managed, not on how much money I was making.
Yeah, it's a percentage, right?
My client, percentage of the assets under management. So I used to tell my clients in a correction, I'll say there's good news. It's only good news. I used to tell them, your income isn't going to change, but your expenses are going to go down because my fees are going to be lower. And that's the way I looked at the corrections, and I looked at my fees. Unfortunately, the people that bought me out didn't look at it that way. They were looking for the AUM. They bought our business based on how much assets we had under management. And we had to make sure that we kept it at that level for the whole year. Actually, it turned out to be about 18 months. after we signed on the dotted line.
Yeah.
So they didn't pay us all right away.
You had to stick around for a while, right? Because
you had to stick around, and you had
Yep.
to keep that market value up.
Yeah. Because
otherwise, you'd
how
be
big was your company?
penalized.
How big was your company people wise when you sold it?
It was my wife and I.
Okay.
and when I was managing 110 million with that.
No, you said that in the book. I just want to make sure, confirm that.
I was dealing through a broker that I had worked with since the 1980s. He and I had built the business together, basically.
Right.
We used to go to trade shows and things like that, and I used to do radio interviews and things.
Yeah.
And we built the business through doing that kind of stuff, and then it was all word of mouth after that.
Yeah.
So when they, so it was 110 million. My share of the business. He had some of his own business, and we had a third guy in his brokerage firm who also had a business. So the total was a pretty big chunk.
Yeah.
Mine was about a third of it.
Got it. No, makes sense. So, what in your book you talk about, you have 6 different principles of investing. Kind of, you don't have to go into detail on every single one of them. What are the basic 6 principles? Because I think that's good stuff.
It is, and it applies equally well to your mutual funds and ETFs and even stocks. The four of them are what I call the great financial risk minimizers.
Yep.
And they're very simply, you have to come up with a way of judging the quality of what you invest in, and
Correct.
And have standards of quality that you apply to everything you own. No exceptions. None. Diversification. No more than 5% of your portfolio should ever be in any one security, no matter how in love with it you are.
Yep.
Just don't do it. It's going to backfire on you. And in my portfolio, for example, I don't have anything that's more than 2%.
Got it.
And it's not
makes sense. I mean, it.
Yeah. So the risk it mitigates a lot of the risk by having good diversification, and that's not just by percentage of portfolio. It's also global diversification, sector diversification, and so on. So there's a lot of different types of diversification. The third one is income generation. Never own a security that doesn't pay you some form of income. Even if it's a 0 coupon treasury bond, doesn't matter. You want the income. You can use the income.
Yeah.
Income builds other income as it compounds. And the final risk minimizer, and this is the one that most people don't employ because they fall in love, and most advisors don't employ because of our litigious legal system.
Right.
And that is profit taking. I mean, if you owned, I always use Microsoft as an example. If you owned Microsoft, one of the lucky ones that bought it early and it went up 100%, and your advisor sold it because it had gone up 100%, and of course it went up another couple 100% after that, you could sue them and win.
Really?
Damages. But, so they're very reluctant to take the initiative of taking profits because of the tax code, particularly in personal accounts. In my business, my agreement, my management agreement with my clients spelled out that I am going to take profits. You will never see a profit of over 10% on any security you own. And when I got into closed-end funds, I moved that down to 5%, to a lower number than 10%. But I made it upfront clear that you're not going to have one of those superstars with me. I'm going to take profits as I get them, reinvest it, and I'm going to grow your income. So those are the 4 risk minimizers. It keeps you from getting to that point where you're just about to retire in 2007. Your 401k is, 1.2 million. Oh, I got enough to retire now. And all of a sudden, within 3 months, you now have 600,000 in your 401k because it was almost totally in equity mutual funds. So, and you don't retire. That's not acceptable to me.
What's funny is that I remember when that happened. My company called an emergency meeting because there were people freaking out. You probably remember those days very well, Steve, to try to talk everyone off the ledge because everyone lost 30-40% of their 401k, their investments.
And some of them probably even sold parts of their 401k and went into cash with it and actually did take the losses. In my case, it was, as you probably would realize, it was an opportunity, yet another opportunity to buy things cheap. And actually, if it weren't for that financial crisis, I would probably still be a primarily stock market investor, because when we came out of, I was buying everything at that time and reinvesting income and buying stuff. We still have two more principles to cover.
Okay.
I got all the way back in, and I was taking my profits as we came out, and the market just kept going up and up and up as interest rates kept going down. And it got to the point where I didn't have any stocks that I wanted to buy anymore, because my buying targets in those days was, it has to be down 20% from its 52-week high. Well, it got to the point where the only ones that were down 20% from the 52-week highs were companies that were actually in trouble, because everything that was good was up. So I was looking for things to buy, and money market rates were going down, and oh my God, what am I going to do? So I thought about, I'd already converted to income closed-end funds for my bonds and mortgages and all the safe side of the portfolio. And then I said, well, look, I'm just going to have to look closer at these equity closed-end funds. And that's when I converted. And I started to convert before more than a couple of years. No one owned any individual stocks anymore. I'd taken profits on pretty much all of them. And then I started investing in the closed-end equity funds, and I've never looked back after that. I only wish it had happened sooner.
Right. So that was actually going to be my next question. When did you? So it sounds like about that time in the mid to late 2008, 7, 8, that you got into the closed-end funds.
Yeah, and for equities
right.
By 2011, 2012, I was totally in them. I had converted to the income side years earlier than that. Two other main principles for any kind of portfolios. You gotta appreciate the cycles, the interest rate cycle and what it does to prices of securities, and the stock market cycle. And of course, there's the economic cycle and all these other things. But those are the two primary ones. Prices are going to go up and down. We don't know when. We don't know how much. You got to get to the point where you expect it, you understand it, and you take advantage of it.
Right.
And you take advantage of it in two ways. You take advantage of it by, buying when things are low and selling when you make a target profit. But you also take advantage of it by understanding where you are in a cycle. Well, right now it's very clear to you we are at the very top of a stock market cycle.
Yep.
Right?
Yep.
Almost every day a new all-time high. So you don't want to be out of the stock market because you don't know how high it's going to go. But you don't want to buy a full position in it. You'll say, okay, I usually start out by putting $6,000 in an initial investment, knowing that I don't want to get up to 5% of my portfolio. This is like 1/3 of that.
Sure.
Okay. So instead of putting that 6 in there, right now, you'd only do 3 or 4. So what can go wrong? The market keeps going up, you take a profit. The market goes down, you can put another, you can slowly add more money to this until gets up to that $6,000 or the next level that you would, so you're taking advantage of that cyclical nature. So that's the other one. The final one, and particularly when you get closer to retirement, when you get to be your age, because you're starting to think about it,
Yep.
is the income. You got to change your focus. You got to say, hey, I've got this 7-figure portfolio here, but if I look at it, and I encourage anybody that's listening to this to go to your investment portfolios and determine exactly how much spending money it's producing. And I will bet you that it's less than 3%.
Yeah, I'm not gonna.
That it's less than 3%.
I'm not gonna dispute you on that one. I think you're right on the money on that one.
So the idea is at some point you have to do that exercise. Okay, I want to take this 3% and I want to make that. It's got to be at least 5.5%. You know why I say that?
Why?
I say that because Wall Street talks about the 4%, rule. When you retire, you're going to need 4% of your market value to live on every year. So if I'm going to need 4%, Mr. Advisor, why are you only making me 3%? And 3% is before your fees of 1.5%. So why are you creating a portfolio for me that's only yielding 1.5% when you know that in 6 or 7 years, I'm going to need to start taking 5.5% because I have to take my 4% and your 1.5%. So that's the question you got to. So to me, you have to get that income focus in time to make your investment advisor set up your portfolio enough to produce that, or do it yourself, and you'll be able to produce over 10%.
Very nice. So what would you say, and I know this is a kind of a loaded question based on lifestyle, but what would you think a guy needs to generate enough income in retirement? Now, granted, that's lifestyle based, right? I mean, if you're taking trips around the world, but the normal, the folks that you deal with, you've seen all sizes of portfolios.
I have. I've seen some big portfolios, but it's pretty. Think about how much you need. If you need, let's say you spend $10,000 a month.
Yeah, I think that's a fair number. Yeah.
You're going to spend $10,000 a month in retirement. You need that's $120,000. So you need, $1.2 million to bring you 10% a year net. All these figures, your expenses include taxes, okay? And your income is net of taxes. So it's what you need. It's the whole thing is the income. So you need to have 1.2 million to generate that kind. And that's just the base income. That's
right.
The base game. Today you can generate 10%. 4 or 5 years ago, you couldn't because interest rates were so low and closed-end fund prices were higher. So, the yields weren't as high as the average yields weren't as high for a diversified portfolio. But right now, you could 10% would be a no-brainer really to generate with closed-end funds, and that's just with the one stream of income that we talked about. That's just with the distributions. So if we're in a typical market environment in a well-diversified portfolio, you're going to have profit-taking opportunities of some nature. You're going to add some more. This year has been phenomenal. This year, in addition to my 12 months of expected income, I've earned another 6 months of income from profit-taking.
Nice.
So in 2020, maybe it wasn't quite so much. 22, it wasn't nearly that much.
Sure.
But in 21, it was more than that. In fact, it was more. I had more income from profits than I had from distributions. So, and that happens depending on when you start the process, of course. Um,
Yeah,
okay,
from
so
the way you
that's.
make it sound, it's never too late, right? I mean,
Oh no, it's never too late and it's never
yep,
too early.
yeah,
It can be. It can be too late. I mean, and there are people who don't have even they haven't had the advantage of being in a position to develop that 401k or that
yeah,
rollover or Roth IRA. Maybe they're just on a fixed pension from
yeah,
something, so who knows?
yeah. You got to have the assets to start with, right? I
You
mean,
got to have the assets, and you have to. And when you're young, you have to develop those assets.
yeah,
You can't start too early.
yeah. No, that's
I, pr-
the one
I,
lesson I've said to my kids: start saving immediately when you get out of time value of money, right? I mean, that's the
oh
basic oldest
yeah, I mean,
principle.
my dad made me give him 25% of the money I made in my lawn mowing business. He even took money from the money I made teaching people how to water ski. Anything I got, because he wasn't charging me anything to live there or anything like that.
Right.
He says, "You got a free ride, son. So the money you make, your tax is going to be to put that away for your future."
Smart
And
man,
that's
your
what he
father.
and that's what he did. He put that money away, put that money away, and that's how I got my start at age 25 when he came out with this envelope full of stock certificates. It plopped it on my table and said, "Okay, you're on your own now, buddy. Don't lose it."
Yeah. It sounds like
So,
you didn't.
that's no, I didn't. I didn't. I took really good care of that stuff.
Yeah. So again, I looked as I was reading this book. I clearly thought about my own life, right? Like I certainly done
Oh,
some good
sure.
things,
Yeah.
but it really started to open my eyes as to, we're raised the traditional. Okay, you got to take 4% out of your investments. It'll hopefully replenish itself. Along with Social Security and what other revenue streams you got coming in, to piece that all together. But generating income, generating revenue really what you said made a lot of sense to me. And I know in my portfolio, I have an advisor. I know there are some dividends that are being reinvested there. I just don't know how much. I'm ashamed to even admit that. But I'm going to find out. I will guarantee you that. So,
Yeah. Well, good. I hope you do it. I hope it's not. Yeah. Well, you have plenty of time, and the key issue for a person who's either reading that book or listening to us right now here in wherever in October of 2024, most people are primarily in the stock market in their investment programs. They may not even realize it, but they are. And even if it's in a 401k, there is a way for you to take your profits by moving from one mutual fund to another.
sure.
You can in effect take your profits in the market and put it into the bond market, which isn't nearly at an all-time high. Not
Right.
nearly. Because we had interest rates that were 0% just 2 years ago, 3 years ago at the most. That's when it was at an all-time high, the bond market. Okay.
Yeah.
Now it's not. So you have the luxury of timing on your side right now where you could say, okay, to your advisor or to yourself, I'm going to take my stock market profits. If I don't have stock market profits, somebody's doing something wrong.
Right.
Okay. I'm going to take my profits in the stock market and I'm going to move a lot of that money into the income bond, preferred stock, a more income focused market, and even the stocks. If I'm going to keep 35% or so in the stock market, I'm going to move that into a diversified portfolio that produces significant income. So there's two things to do. There's to take your profits and then create a new portfolio that's income focused instead of market value focused.
Very good.
And we are really at an all-time high of the market. I don't know if it's going to go higher or not. It certainly can. It may not. A lot
Yeah.
might depend on what happens a month from now or
Yep.
less than a month now, isn't
Yeah.
it? It's only 17 days away or something like that.
So how does an election, and we're not going to get into politics here, but how does an election affect the stock market, do you think? What have you seen?
I was thinking about that. Look at where the market is now.
Yeah.
The economy is great. Jobs are plentiful. There's no unemployment problem. inflation sucked. It still is higher than it possibly has been, but
Yeah.
it's not what it was. Unfortunately, prices are very sticky downward, and we're not going to. You're going to continue to see $40 pork chops out there on your
Yeah.
on the menu. Until people stop buying it at those prices aren't going to go down.
Yeah.
We
No, it's
are
funny.
in
I
control.
went to the grocery
We're
store
in
yesterday.
control of inflation.
Yeah. So that's a good point. I'm buying way less steak than I used to when I see, like you said. I'll give you one. One of the big wholesale clubs I went there, I won't name them. I went and we were having company, so I went to buy a tenderloin, one of those big ones that you cut up.
Oh, yeah.
I remember a few years ago, that was about $70. It was double. It was $140 to $150 for a piece of meat. Granted, I'm like, wow. Now, granted, the argument can be made, hey, if you went to a restaurant and bought one piece, it would be $50. So, you're getting way more than that. But still, I didn't buy it. I didn't buy cigar. I'm not buying it.
I don't buy single malt scotches when I go out for dinner anymore. I'll have some Jamesons.
Yeah. I know. I mean, you go out and you have a decent glass of scotch, it's $20-$25.
I know.
I mean, it's insane. I mean, back in the old days when it was, we're showing our age here, but when, a drink was $2 and $3, $4, you could drink all night for $50. Now that's a couple drinks.
I know.
Crazy.
That's what a situation like pandemic will do for you. It cuts off that supply chain problems, and once the prices go up, they don't go down. I mean, that's economics 101. Prices are sticky downward. It doesn't happen.
Yeah, that's what I say. I don't see prices going down. I mean, there's
But we were talking about the election in a nonpartisan way. Everything is fine now. We have it's a very close contest here.
Yes.
It's, whichever side wins, the other 45% is going to be unhappy, but the 55% is going to be ecstatic.
Yeah.
So how is that going to affect the stock market? Who's got the most money? It's hard to say.
Yeah.
So I have no idea. If it happens, it's not going to be life-threatening. I mean, the market's gone down 1,000 different times. I don't think I'm not sure. I can't really say any more opinions without bringing politics into it.
Yeah.
But overall, in past elections and past political events, any election-related changes have been short-lived.
Yeah,
I would say.
I would agree with that. If you look historically, like you said, step back and look at the history. The stock market has always done this. If you step back, right? So if it goes down, it's going to come back up.
The trend. Yeah, the highs are always higher and the lows are always higher.
Right.
Right.
Yep.
Very rarely does it dip so far down. I mean, the Great Depression, we're not getting back to a 3-digit Dow Jones Industrial Average. I don't think so.
Yeah. No,
when I started investing, I think it was 1,100 or something like that. What was it back in 1979? I don't even know anymore.
I was in college back in those days, Steve. I didn't own any stock.
Yeah, I was already 16. No, in 79, I was 34.
79, I was 20. Born in 59. Yeah. So yeah, I was just still in college, drinking, chasing girls, doing what college kids do,
Exactly.
So, well, Steve, this was great. I enjoyed this. I hope the people out there get a flavor for this and start asking questions of their advisors and start learning more by A, reading your book, or B, they can contact you. I know you got a Facebook group. I joined that this morning, so I'm going to start really doing my homework on this. And but if someone wanted to get in touch with you for some coaching advice, how would they do that?
theincomecoach.net is my website. And
awesome.
It lays out, all the different types of services they can get and a little bit about me and my background and so forth.
Yeah, very good. Well, we'll end on that note, Steve. I really enjoyed having you on. I really enjoyed the book, and I've already told my wife she's got to read it too to kind of. But as you know, like when you're married, and you make financial decisions, you got to make them together, right? You can't be
Oh, you better. Yeah.
Yeah,
sure
you better, because if it doesn't work, you can't point the finger at one another,
Right. Right.
So, well, great.
Sometimes I've coached for couples where they've each had their own portfolio.
Oh, wow. Okay.
The one would say, "No, I'm not ready to do that yet," and the other one was jumping right in. So
yeah,
in
very
that case,
nice.
it's easy because they each have their own money. So
yeah, no, good. Yeah, that's a good point. So, well, Steve, thanks again for being on the show. I really enjoyed it, and I'm gonna start really looking. You got me hooked on this stuff, so I'm definitely gonna start taking it a little bit more seriously than I have. And who knows? I may be calling you up for a coaching session.
Give me a holler if you need any help.
Will do. All right. Well, that's a wrap for this edition of the Business Brains and the Bottom Line podcast. Again, thanks to Steve Selengut for being on the show. And I would highly encourage everyone to go out and buy his book. Until next time.